A very warm welcome to all our clients that have joined us today. It's my absolute pleasure to host you. My name is Samira Franisevic. I'm the Regional Head of Wealth Advisory for Citi. And it's my pleasure to have Patrick Sin, who's Head of Counselors at Singapore, join us, as well as James, who's joined us from UK, who's the portfolio counselor in the UK. So the topic of today's conversation is the incredibly low cash rates or bank rates that we have at the moment. And as clients who are sitting in a lot of savings in the bank accounts, what options do you have around that? We'll start off with talking about why cash is no longer king and what's impacting the cash rates to be as low as they are. And for clients then who are looking for other alternatives, what are some of the key fundamentals that you need to consider before you look at other investment options? And Patrick will help us cover that. We'll also look at some of the market volatility, which is very prevalent in the share markets at the moment. What does that mean for clients that may be looking at some options that may incorporate investing into the share market? We'll also then cover the fundamental principles of a diversified portfolio. If you're looking at investing, how can you make sure you have a diversified portfolio that is relevant to your investment objectives and your risk profile? We'll also cover some examples of investment options, and then we'll open up for question and answers. So, if you look at interest rates at the moment, they've been on a steady decline for some time. The pandemic and COVID-19 certainly accelerated that decline, with central banks around the world slashing the cash rates, which then had a flow-on impact on what you're actually getting on your cash savings. And the Citi analyst views are at the moment that the low interest rate environment is here to stay, likely here to stay for at least the coming few years. The extraordinary low interest rates are fabulous. If you have, like me, if you have a home loan, it's certainly been very, very beneficial as the rates have come down quite significantly. But if you're lucky enough to have a substantial or any savings in the bank account, then that's also hurt, that's hurt a lot of our savers. Because you're certainly not getting a lot of interest rates, and progressively you've seen the interest rates being offered on term deposits or even savings lower and lower. For example, if you had some cash at the moment and you're looking at putting that into a 1-year treasury bill, you're looking to earn about 0.13%. And by looking at the rule of 72, which calculates how long it will take you to double your money. So if you were to reinvest that interest rate, it'll take you more than 553 years to double your money. So it's certainly not the best if you're looking to grow your savings. So maybe my first question would be to James. Can you help explain why cash rates are so low, and how is that impacting our clients who do have a lot of savings in bank accounts?
Sure, and thank you very much, Samira. Great to be on today. And I think, look, as you already mentioned, ultimately since the global financial crisis, central banks have held their policy rates low in order to make borrowing cheaper and help promote economic recovery. So sitting it out in less volatile asset classes used to make the question of when to invest easier on our investors. So for example, from 1981 through to the global financial crisis, investors could earn positive real returns in, say, a low-risk sovereign bond with a lower return, but about, let's say, 1/4 the volatility or risk of an equity. So after an interlude of the period 2013 to 2019, when US real yields did rise slightly, although European yields stayed negative, inflation-adjusted yields are now negative in the US again. So I think that brings us quite nicely onto our first slide. And as you already mentioned, one of the key themes here is for excess cash. Cash is no longer king in that sense. So just firstly, what do we observe from this chart? So the light blue is the US nominal federal funds rate, so nominal yield less inflation. And then the dark blue line is the 10-year Treasury inflation protected security, so a security issued by the US government that's linked to inflation. And what we can clearly see here is that when we're talking about cash rates, if we account for inflation for those investors that are holding cash, actually over time, the purchasing power of that cash is diminished. And so what we say is on a real basis, actually you're making a negative real return. And just as a very brief note to cover inflation. So what is inflation? Put very simply, this is a rise in prices. And what is the risk to the investor is that whatever asset you're holding, in this instance cash, it doesn't rise at the same rate as prices. And that's really what we're saying here. And so just to illustrate this further, if we move onto slide 4, we can see that really, this holds across markets. So it's not just the US dollar. So for example, if we look at the Eurozone, in actual fact, it's the deposit rate here in dark blue is negative 50 basis points. The main refinancing rate, that is the European Central Bank rate, is actually 0%. And then we can see here an annualized figure for inflation across these markets. So again, looking at Europe, 5-year, and then we annualize that inflation is 1.4%. The United Kingdom, again, cash rate, so think about this as a deposit rate, 10 basis points, with the 5-year annualized inflation at 1.7%. And again, United States we've covered. So at the time we put this together, the federal funds rate 9 basis points. And indeed, we see here on this slide, the inflation at 1.81%. So what does this mean for you as an investor? And what is the key theme here that we're trying to pass to you? Is that ultimately, look, we all require cash for our daily lives, but for holding your excess cash as cash at the moment in an interest-bearing account, simply put, this will not maintain its purchasing power through time. Therefore, as wealth managers, and again, one of the key themes of this presentation, we must look for opportunities, to make this cash work harder within, your risk and return tolerance. So yeah, Samara, as a brief introduction to cash rates, I think that's all I wanted to go through in these 2 slides, and so I'll pass it back to you.
Thank you, James. That was very useful. So Patrick, if I could come to you, like James said, that as wealth managers, our role is to help clients to see what other options are there. And whilst there are loads of multiple investment options out there, not everything would be appropriate for clients. What are some of the key fundamental things that clients need to consider when looking at investing options?
Yeah, hi. Thanks, Sumaira. Yeah, indeed, it is true to, when one is about to embark on an investment journey, it is advisable for investors to take stock of their current situation and consider some of the key factors before they start, investing. Sort of like packing one's luggage for a holiday journey, right? In order to decide what to bring along, whether it's summer or winter clothes, or the types of sporting gears, or even, the types of currency, one needs to know where one is kind of headed and where one is right now. So first up, I think, one should consider the investment objective. What's the purpose of that particular investment? Is it to grow your capital, or is it to have a stream of income through the investment that you're making? Typically, if you think about it, to a large extent, the stage of your life that you are at, right? If you're single or you're a young family, you're likely to have a regular salary in that phase of life, and you would likely to be looking for capital growth in your investment objective. Whereas if you're near retirement, you may be seeking an income stream, right? Even for capital growth, well, it's kind of also hard to put a specific return targets, for investment, unlike deposits where there's a fixed, rate of return. But the principle generally is that high risk, high return, and low risk, low return. To give you a sense of, global equities, for example, they have yielded about 7 to 9% annualized return over the long term. Coming back to income objectives, right? So you probably be able to only achieve that through, the products like bonds or REITs, which offer more regular, consistent income, whereas dividend income from stocks tends to fluctuate a fair bit. So investors can actually combine, different types of investment to derive the income that they are seeking. So knowing your investment objective therefore forms the basis of why you are investing for, right? The next thing to look for is actually an understanding of your own risk tolerance, both in terms of ability to take risks as well as the capacity to take risks. Let me elaborate a little bit on that. In terms of ability to take risks, I think it largely depends, well, it's somewhat subjective, and largely depends on one's own investment experience, as well as, to a large extent, the threshold for potential loss that one is willing to accept. Many new investors have difficult time to assess this, right? So, but having an appreciation of how different investment in stressful markets will behave will certainly help them to appreciate their threshold for potential loss in situations like this, and therefore determine their willingness to take risks. In terms of capacity to take risks, it is actually slightly more quantifiable, and it relates to one's own financial status or amount of wealth. How much of this wealth is one able to lose without hurting one's standard of living or other financial goals? So for example, how much of my total net worth is investable or can be investable? And if I were to lose the entire amount, will my lifestyle and financial plans be devastated? If not, then can one adopt a highly aggressive risk profile? Well, if the capacity to experience loss is actually lower, then the risk profile will definitely be, more moderate or conservative. So on an overall basis, actually one can have a capacity to take risks, but not the willingness to take risks, or vice versa. This, of course, will moderate the risk profile further. So having a clear appreciation of one's risk profile is one of the most important key to successful investing. Next up is investment horizon, long-term versus short-term. Typically, in terms of length of time, short-term refers to a horizon where it's less than a year, and mid-term is probably between 1 to 3 years, and anything beyond 3 years is likely to be long-term. Typically, if one is accumulating wealth for specific financial goals, such as children's tertiary education, capital for startup business, retirement, nest egg, and so on and so forth, these financial goals will help one or help the person investing lay out an investment horizon naturally, right? So building income for retirement will probably have a much longer horizon than accumulating wealth for a holiday next year. So it's important to align one's investment towards these future goals, future financial goals, because then it will provide a sense of the length of time for wealth to compound, and this will enable investors to stay invested for a long time after setting up their investment. Remember, it is the length of time that the capital remain invested that matters more than timing in the market with speculative trades. That's how one can build steady growing wealth through investing. Having said that, of course, there are investors who seek thrill and excitement in investing and may prefer short-term tactical trading with less than 12 months horizon. Well, these, of course, can further be differentiated, right, with short-term money market funds for temporary parking purposes. So not all short-term trades are meant for are highly speculative or trading in nature. Again, the key here is setting one's time horizon will help investor think about his investment approach, whether he would like to approach his investment in a slow and steady fashion or fast and speculative manner. Next up, one should consider a lump sum versus regular saving as well. I would say that for most of us who are in the accumulation phase of our life stage, single, young families, midlife, reality is that we don't all have the lump sum to preserve or grow for retirement use one day. As we earn and spend and save, we have some spare along the way, and thus we'll be investing in many, many intervals, right? Actually, this may not be a bad thing. especially for an aggressive investors who prefers to invest mainly in equities, which are much more volatile. And there's been evidence that this approach of dollar cost averaging is a good strategy for an equity investors. For those who have accumulated a lump sum and is seeking to invest for yield or income, perhaps it makes sense to invest a lump sum, particularly in a couple of years back when yields was a lot higher compared to now. In order to lock in the yield, one would probably have to invest a lump sum in maybe perhaps in a specific bonds by a single issuer, and the quantum of investment is fairly large, and therefore one has no choice in order to lock in the attractive yield. He may have to invest in a lump sum approach. But in practice, actually there'll be opportunities for both lump sum and regular interval investing, depending on one's preferred investment outlook.
Even with lump sum, though, you should be able to drip feed that if you wanted to, right? So it's not like you have to, if you have a lump sum, you can invest it. You have to invest the whole lot. If you feel more comfortable, you're able to drip feed that appropriate to your risk profile.
Certainly, yeah. Well, going on to a couple more points, minor, but nevertheless still worth considering is liquidity. Liquidity, of course, is how fast an investment can be exchanged for cash. So this is usually a function where there's a ready market of buyers and sellers on a daily basis. So typically, examples like stocks and shares, they are traded almost daily with many buyers and sellers in an exchange, right? Versus, say, maybe real estate or investment in arts, which is not as liquid due to the lack of ready buyers most of the time. And for most part, Citi actually tend to prefer investors to invest in highly liquid investment unless there's an extra compensation built into the non-liquid investment. So for example, private equity should potentially yield higher return than public traded equity due to its illiquidity premium. Last but not least, of course, is foreign currencies. I think if one were to choose to invest globally, one cannot avoid currency risk totally. But having said that, these can be mitigated. There's a lot of products that offers currency hedging options, and so this will mitigate the foreign currency risk when one is exposed to the underlying investment. So in summary, one should start with self, right? When thinking about embarking into investment, right? Understanding your own circumstances, goals, objective, willingness and capacity to take risks, right? These are important considerations. And having that clarity and focus in this consideration will help you set up proper investment portfolio, right? To meet your objective. Making a lot of money in the shortest possible time, right, is not a realistic goal. In fact, it may be a bad goal that forces one to take highly speculative risks in order to achieve this goal. So the success of growing one's wealth is to be able to differentiate between short-term speculation and mid-long-term investing.
Right.
But unfortunately, last but not least, in investment, we cannot divorce risk from return, but we certainly can reduce and manage them carefully to our advantage. And diversification is the only free lunch in investment.
Yeah,
right?
Which we'll come to, right?
Yes.
Which we'll come to in a minute. Thank you very much. That was really, really helpful, Patrick. What are the other things that, when you talk about investing, we've certainly seen volatility as being one of the common themes that come up. Every day we see headlines that are about markets being up and down overnight. We've had markets come up because of really positive news on the COVID vaccine. Early in the year, we saw share markets have the fastest drop into bear market, which is a 20% drop, followed by one of the most, dizzyingly fast recovery, one of the fastest recovery we've seen in a while. So James, for clients looking at the markets, even when you know your risk profile and investment objectives, it can be quite daunting with the ups and downs. So it'd be really good if you could quickly cover, what does volatility mean, and is it something clients should be fearful of?
Yeah, sure. Thanks, Marion. Firstly, I really like Patrick's expression that diversification is the only free lunch in finance. So we'll come on to that a bit later. But yeah, agree, of course. Look, and I think volatility is just another way of speaking about risk. And risk is a normal function of markets. And again, as Patrick stated, really, ultimately without taking risk, you don't get a return. And as a client, it's just making sure that you are taking the appropriate amount of risk, given your ability to take risk, and also your willingness to take risk within a portfolio. And so really, just very briefly, what we wanted to show on slide 6 is that, again, volatility or risk, again, is a normal function of markets. And so what we see here is a fairly specific example. So the S&P 500, a broad-based indexed measure of the equity market in the United States. Hopefully, most people are familiar with that. And ultimately, what we're saying here is that, yes, through time, there's been some fairly significant, let's say, negative events for markets. So, for example, the 1987 stock crash, the 1990-2000 dot-com bubble, the global financial crisis from 2007 to 2009, and of course, most recently, the exogenous or external shock to the financial markets from COVID-19. But however, Samira, to your point, what we observed was an extremely rapid sell-off, followed by an extremely rapid uptick in markets. And so, yeah, again, really, as long as you have a diversified portfolio and that is within your risk tolerance, this is nothing to be afraid of. This is how we realize a return. And just to really illustrate that, I'd like to move on to slide 7. And so, yes, this is about timing the market, but just as a brief note before I go through this. So one thing I think that we observe as wealth managers is that many investors assign greater anxiety to the fear that their decision to invest today will be poorly timed and they may suffer immediate losses. Therefore, investors appear to believe that if they enter markets early and suffer initial losses, they'll lose more than if they had just waited. And what I really wanted to show here is the case for not trying to do that, not trying to time the market, and also remaining invested throughout market cycles, throughout the volatility. And so what we've showed here is the annualized returns by decade on the S&P 500, and specifically the real key point here is the opportunity cost of missing the best 20 days of that decade. And this holds across the four examples we've got here. So if I just pick one, so say 2008 to 2017, we see that the annualized return here on the S&P 500, if we'd held that index investment throughout this time, 8.5%. However, if we'd missed the best 20 days of that decade, our annualized return would have been negative 2.8%, or an opportunity cost of negative 11.3%. So, look, of course, throughout time, we rebalance portfolios, but the case is simple. Don't try and time the market, and try to remain fully invested in the core portfolio throughout periods of market volatility. Because again, this is a natural function of markets, and so again, nothing to be afraid of. And again, as Patrick went through, this is one of the things that we really try and outline to our investors at the start of the process when we're going through things like your risk and return objectives, any constraints you may have, your time horizon, and any liquidity needs and things of that nature. So I think that brings us nicely to the next slide. And so Samira, back to you.
Yeah, sure. Thank you very much for that, James. And picking on it's free lunchtime then, Patrick. One of the key principles of not only just dealing with the market volatility, but also making sure you have a robust investment plan or a portfolio, having diversified assets or diversified underlying investments is really important. The old adage, not having all your eggs in one basket, comes to mind. So it'd be really good if you could quickly take the clients who've joined us through what does it mean to building why it is important to build a diversified portfolio, and how do we do it at Citi. I'd also like to remind a lot of our clients who are with us, you're more than welcome to submit any questions that you have that we're not covering at the moment through Veracast, and if we have time, we'll absolutely be able to cover that after we've covered the slides. Over to you, Patrick.
Thank you, Sumaira. On this slide that looks like a checkered blanket, the table actually shows over different decades, the performance vary for each different asset classes, right? But having said that, most of them over the long term have yielded positive return, despite the fact that equities have generally been much riskier than bonds, and bonds than cash. It shows that there's no consistent outright winner or best investment throughout the decades. Equities have potential for highest return, but do not necessarily become winner in every decade. In the 70s and the 2000s, right, emerging market debt or government bonds issued by emerging markets like Latin America, Middle East, Asia did better. In the year 2000, the US technology stocks crashed and brought the entire S&P down as well. Well, in the 60s and 80s, these periods were much more favorable to equities than bonds or cash. In fact, in terms of decade returns, the one that's really stood out is that cash return is very, very poor as compared to the other asset class over the long term. So historically, at different phases of economic cycle, different asset class will perform differently. Typically, in a slow growth, low inflationary, and falling interest rate environment, bonds tend to do better. And in a strong economic growth, moderate inflation environment, risk assets like equities perform better. So in this sense, equity and bonds do not necessarily move in tandem or in concert given the same economic environment. In addition, the potential loss experienced by equity and bonds differ greatly under the same economic condition. Equities' potential loss is much, much greater than bonds. Overall, bonds and equities have low to negative correlation over time. So with this difference in their behavior, actually by combining them in different proportions in a diversified manner to form a portfolio, investors will be able to reduce the total risk of their investment portfolio. This will result in a smoother returns and lower volatility, and possibly more assured return with lower level of potential negative drawdown on an overall investment basis. This is the free lunch that I spoke just now and that many investment experts talks about, portfolio diversification, right? We can take a look at the next slide to see, Citi's model portfolio. So in the next slide, you can see that across the board, Citi model portfolio is made up of different portfolios with different risk classes. It's designed to help clients construct or put together, right, a portfolio at different risk class level. For each risk profile, a specific level of risk is established first, and then a portfolio optimization process will determine the recommended combination of the various asset classes. Broadly, in Citi's term, we have chosen 9 asset classes, including cash. In fixed income, for example, we have, global investment grade, global high yield, emerging market debt. And for equities, we have, US equities, European equities, Asia, ex-Japan, and so on and so forth. For example, for conservative risk profile, the risk level is the lowest, and thus it has the largest allocation in bonds, as high as 95%. On the other hand, the very aggressive and specialized risk profile has only 3% in bonds, with major allocations in the other sub-equity asset classes. So this indicates that very aggressive portfolio is likely to have potentially a higher return, I say potentially, a higher return than conservative portfolios in the long term.
James, I'm actually going to ask a client question that's just come through with respect to this, right? They've asked what's our view on silver and gold.
And so Citi model portfolio seeks to to participate in global opportunities, which explains why we have various regional equities and debt. In Citi, we believe that we can help our investors achieve better risk-adjusted return in global multi-assets portfolio. Thus, it does not only ensure high level of diversification, it also seeks to capture the best opportunities available on a forward 12-month outlook basis. And we will also review this asset allocation quarterly to kind of reflect Citi's best view.
So just to elaborate a little bit more, the question was around our views on investing into commodities like silver and gold.
Sorry, hi Sumaira.
Yeah, I'm Sumaira. I'm happy to
sure. Yeah.
So the first thing to highlight is
over to you, Sumaira.
I'd say have we lost Patrick? We lost Patrick's audio.
It's okay, James. You can answer.
Yeah,
the question.
Sure. So yeah, I just wanted to clearly bifurcate the two. So really, although they form part of the precious metals group, silver is much more of an industrial metal. So if you're looking at silver, really what you're saying is that's more of a play on a pickup in industrial production, which in turn would imply an increase in demand. So if you were to look perhaps into the latter half of 2021, yes, we've seen some upside for silver already. And I think to see further upside, really you're looking at a return to some semblance of normality when we have either, let's say, a therapeutic and or vaccine type treatment for COVID. So, the patterns of consumption are normalized. Again, industrial production goes up. Perhaps we are producing more electronic goods. And that's really what I'd say in terms of silver. Yes, for gold, look, of course, the traditional, let's say, inflation hedge, perhaps a downside hedge for portfolios, which has worked up until now, albeit we've seen, silver really bid up, gold really bid up throughout this fairly volatile period. One thing I'd really highlight as well, and it goes back to the interest rates we've discussed, is that, let's say, year and a half ago, in US dollars, clients would have been able to maybe earn, 2% if they're willing to take some limited investment risk. But now, of course, really effectively, the federal funds rate, when I last looked, was 9. The effective federal funds rate to do the actual supply of dollars was about 9 basis points. So it may as well be 0. So what we've seen is, well, if a client is now not going to hold dollars because they're not going to get that 2%, the opportunity cost of not holding dollars is much reduced. So we've seen some shift into gold. So say in the context of a portfolio, really the gold allocation, the way to look at that now is as a real downside macro hedge, especially given that we've seen the fairly significant price increase, particularly over the last 6 to 9 months. Yes, silver has increased as well, but I'd say the silver play is more on the basis of an increase in demand, an increase in industrial production, things like electronic goods and things of that nature. So again, it really depends on the client and their risk tolerance, if you will, and also how you are holding the gold or silver. Are you holding it physically, or are you investing in it electronically? Through some sort of fund. So in summary, both have perhaps a role to play, depending on the client, depending on the portfolio, but would complement an investment portfolio very, very differently because of the way in which they are, their role, let's say, in financial markets. So gold, more of a store of value, traditional hedge, silver, more of an industrial metal. So hopefully that helped.
Thank you for that. And Patrick, if I could, there's a couple of more questions specifically on the portfolio asset allocation. Before I go there, it'd be really good if you could quickly cover risk versus return trade-off. I'm mindful that we've only got 10 minutes left, and we still have a few slides to go and some client questions coming in. So what I might do is if we could quickly cover risk versus return trade-off with respect to the portfolios that you've chosen, and then I might revert to the actual client questions that are coming through.
Sure. So very quickly on the next slide, which is our Citi model portfolio risk-return trade-off chart, you can see that vertical axis represents the return, and the horizontal axis represent the risk. Below the chart is the table of the model portfolio performance, as well as the volatility data. You can see that, the principal held up pretty well. High return, high risk, low return, low risk. But having said that, interestingly, you can see that in risk profile 2, the portfolio has yielded 5.5% per annum, annualized with a volatility of 6.9% per annum. And what it means is that the portfolio return will range between negative 1.4% to 12.4% return annualized over the last 17 years, 2/3 of the time, right? So what it means is also that there's a larger probability of the portfolio achieving a positive return most of the time. Compare that with risk class 5, which is which has a a range of return ranging from negative 10.1 to 28.3% return 2/3 of the time in the last 17 years. So obviously, if you were to pick a portfolio, you need to weigh whether you are going for a higher probability of positive return, or you specifically is aiming for a targeted return which is much higher, but you're willing to take a much higher risk, right? So in Citi, the choice of which model portfolio to adopt is determined by your risk profile. But however, if you are uncomfortable with your actual risk profile, you ought to select a portfolio to reference from that is of a lower risk profile. All right. Okay, note that I would like just to, as caveat, note that Citi model portfolio are meant as a reference portfolio to suggest the combo or percentages of asset allocation for each asset classes. They are not actual investment in itself. So we have proxied the various indices to represent each of the asset classes, which is why we are doing, a quarterly review assessment of these asset classes as well. Over to you.
Absolutely. So what I would do is I'll probably revert to some of the questions that are coming in, right? So one question that came in was around REITs, right? And the question was that they didn't see REITs as a specific asset allocation on the model portfolios. What type of investors should have exposure to REITs? Patrick. Yeah, go ahead, Patrick.
Yeah, I can take that. REITs, it's considered an alternative asset class in Citi's view, and we do have another set of model portfolios catered to what we call accredited investors, and or which has allocation in alternative asset classes. And so REITs typically comprises as an alternative asset classes. Gold is one of them. REITs is included as well. REITs will remain at about 5% allocation, plus minus with some deviation of 2% to 3%. So that's the amount of allocation that is suggested based on Citi models portfolio.
Thank you for that. James, a question for you. We talked about volatility, and the question was, what's the best investment for today and after the pandemic? Obviously, we don't have the looking through glass. We can't forecast what's the best. But given we've had quite a substantial change with the pandemic, how do you see this impacting clients' investment now and then going forward?
Yeah, I think that's a great question. I think it really depends on the investor, but I'll try and answer it as best as I can. So really what we've observed throughout particularly the last 2 quarters is, for example, the technology sector has been it can continue operating during the lockdowns that we've had and the shock to the normal patterns of consumption and demand. So in our house view, what we do think is that those sectors that are much more cyclical, aren't so much orientated towards technology, are those areas that our clients could consider adding to their portfolio. So if they're looking for an equity type of investment, whether through a fund or something else, that is to say, those areas at the moment are still significantly discounted, even though we've had some positive news recently, because the market is still not quite sure when that's going to be available. And these are the areas that we think have been neglected for perhaps for good reason this year. But at
So
some
when you say
point,
cyclical, could you give us some examples of what those sectors are?
yeah, of course. So things like, let's say, financials, industrials, consumer discretionary, so things that we all perhaps buy, but when times are a bit harder, or things are a bit more volatile, we choose not to. These are the areas that perhaps at the moment are unloved by the market. I probably won't go too much into value versus growth, given the time, but would just suffice to say, relative to something like US technology in particular, are fairly significantly discounted. So in the equity space, this is one area where a client could consider adding to their portfolios. For a more risk-averse investor, and perhaps an investor that wants income, again, it really depends on for example, the currency you have. But if we just pick US dollar, we still think that perhaps there's an opportunity in US investment grade corporate bonds. And indeed, if we just reference the Treasury, 10-year Treasury, slightly different, we saw the yield pop up significantly as the market switched from, let's say, a more risk-on approach to whereas we'd been slightly more defensive. So what we're saying is that actually investors are selling those bonds, so pushing the prices down, the yields up. And so it could be slightly more attractive there for an investor that's looking to add something more defensive, and or something that generates income into the portfolio. So those are two suggestions. But really, again, the approach that we have here at Citi is that every investor is different, and so it really depends on your own. To Patrick's point, your risk and return objectives, what your investment profile is. But to summarize, if I was to pick one area from the equity space, the more cyclical areas, so things like financials, industrials, and we can be a bit more specific about region, again, depending on the client. Or if you were looking at the fixed income and you had dollars, perhaps US investment grade corporates, we still get a reasonable yield, maybe 1 to 2%, and that may get more attractive as, again, we see a normalization, in our view, into the second half of 2021. So those are two areas you could look at. But again, very broad question, so hopefully that's helpful.
Yeah, that's very good. James, if you could use the last 1 minute to, before I close the call, just to very quickly touch on the long-running trends that we at Citi look at and talk to our clients about. Long-term trends.
Yeah, of course. So healthcare is one area we like. So aging populations globally, lower spending in emerging markets at the moment, something that might change over the next decade. Plus, demand is less impacted by economic cycles, but demand is relatively inelastic. We also like Asia emerging markets, really driven by mainland China, and the growth in the middle class, in our view, that we will see over the next decade. And indeed, we observe this now that China is making that transition from a society based around industrialization to consumption. And indeed, we see that as a very, very powerful powerful trend. And thirdly, digitalization, technology. We've touched on. Yes, in some instances, valuations are looking slightly higher. However, for the next decade, again, as part of a portfolio, it's an area we do still like, and investors could look to add to that, let's say, more systematically. Again, in our view, as we look to the cycle from, again, those more defensive areas, things like technology, utilities, into the more cyclical areas we've discussed, investors could look to add in small increments. Assuming that does happen. So in summary, healthcare, Asia EM driven by China growth, and also digitalization are three really powerful trends that we believe at Citi our clients should consider for their portfolios.
Brilliant. Thank you so much. And thank you very much for all the clients that joined us today. I hope that you found that of value. We didn't have enough time. There's quite a few questions that still came through. We just didn't have time to cover them, but I really encourage you to reach out to your relationship managers in countries to ask them those questions and certainly discuss what options are available to you to consider and discuss your investment objectives and risk profile and all of the things that James and Patrick have covered today. Very, very deep gratitude for joining us, and thank you very much, James and Patrick, for your help in explaining some of these concepts. Thank you very much for joining us, and hope you have a safe and great day.
Thank you.
Thank you,
everyone.